Let's talk some volatility and circle back with a guest from last week who then said equities are ready for a pretty serious bounce due to volatility dynamics. We got it on Monday. Time for follow-up. Cem Karsan is back with us, Senior Managing Partner at Aegea Capital Management. So, Cem, welcome back to the show. And first of all, walk me through kind of what you saw on Monday and how the easiest way is to explain what happened according to the thesis you laid out. I mean, it looks like it kind of happened the way you said it would. We had a totally random rally in equities like we haven't seen in weeks.
Yeah, it was textbook. Going into options monthly expirations, which is the week we're in now, the Friday into Monday period, right before that expiration is generally a very bullish period. This is not just technicals or whatnot. There are structural buyers of market deltas based on something called VANA, basically as options decay, and they primarily decay over that weekend into that last week. You get buyers of deltas of the market, and there was a particularly big high skew in that options expiration, particularly high implied vol relative to the curves. That based on order flow analysis, basically told us that market makers were very short out of the money puts, long out of the money calls in that expiration, and had a lot of deltas to buy back. So there's a lot of flow coming in. Pair of that with the fact that it was Columbus Day, you had a little bit less liquidity than normal, and not surprising, textbook, we get a really big rally that comes out of it. Okay, so I think
I just want to jump in real quick because I think a lot of people understand the terms that you're using. A few there that I'm not sure I recognized: VANA and charm. I must have missed those on the Greeks lessons.
Yeah, absolutely. They're second-order derivatives of the underlying. So, VANA is actually per percent move in implied volatility of the options. It's the amount of deltas that you have to buy or sell. As implied volatility comes down into expiration, you're going to have a lot of deltas to buy if you're a short put long call. Idea being, you're short the underlying, you're short the put, you're short the long the call, short the underlying. So you have to buy back the underlying as your out of the money options disappear. Charm is essentially the same thing, but as a function of time. So per day move in time, it's the amount of deltas you have to your position changes by. So the amount of deltas you have to have by. So I talk about VANA and charm. I kind of talk about them kind of together generally because as we're moving forward in time, you're going to have to buy, but generally volatility also comes down as long as the market doesn't move over time. And so the two kind of work parallel. Okay, so I'm sure I'm oversimplifying by this, but the kind of core here is that big institutions that sell options had to basically cover options that then, when the market didn't drop enough, then they had to go and buy the underlying stock, right? So if the market stays up to a certain level, it gets kind of this extra boost on top of it, and it turns out there was a lot of boost this time. Yeah, absolutely. So dealers broadly are short put, long call, market makers, banks. They're short put, long call because the world buys puts and sells calls against their long positions as protection. So when they're short, particularly a lot, they end up in a situation where they have stock to buy back as long as the market doesn't decline through or rally through their positions. And so broadly going at expiration, you tend to get a lot of delta buyback as long as the market hasn't made a particularly big move.
Okay, that was largely what you attribute Monday to. Now I follow you on Twitter at Cem Karsan, quite a handle, but it sounds like you're moving the other way now, where you're preparing for potentially a pickup in vol. Is that right?
Correct. So these VANA and charm flows accelerate exponentially into the Monday, Tuesday of expiration when they're particularly high. They have a strong effect coming at the tail end of what was a technical rally. That was oversold. We found ourselves in now a overbought scenario where those VANA and charm flows are gone. Other structural factors or buying factors are no longer there. And we get into a cyclical bearish time. Why? Because we're entering a 5-week expiration cycle. These VANA and charm flows are basically non-existent for several weeks. You're also kind of still in not great seasonality, as well as, you're getting several other important factors like, a lot of equity call buying from retail, sentiment shift, et cetera. So you put these all, we have a 24-factor model here at Aegea that we kind of look at the market on, and all of those things have really turned, and really pinpoints a great period where the market has been overextended, and you should be looking for pullback. I called this on late on Monday after the end of the day, and sure enough, we got a pullback that was met with vol buying. So implied volatilities were rising into the rally, which is always a classic sign, as well as we got that skew and vol kind of reversion in October to the rest of the curve, which told me that the buying was done. So yeah, now is the time to be defensive for the next week or so, to kind of watch and look, see how the market reacts technically. We're at an important point because of the election coming up as well. You really want to keep technical strength, and you don't want to kind of kick off any trend following selling out there, any vol targeting selling, any of these other flows that could really kind of turn the tide. So it's an important time to kind of wait, watch, take a short kind of view, maybe a little bit long vol, particularly in an election vol, which is really cheap right now. And if we get through this week and a half without any real structural damage, it can be it can be a good sign to kind of hop back in and get long again. But you really need to kind of be very careful during this period of time, in the cycle.
Hey, just last point here. If you're a technical analyst, a technical guy will come on, he says, okay, I'm looking at this level as a place to where my theory comes to fruition. For your volatility inputs, do they give you any idea on how to think about ranges at which some of these forces might then be removed from the market, or is that something you just watch and develop to see if those forces accumulate and become even more powerful, or is there a certain level where you go, okay, that was it?
Yeah, it's not. I mean, look, we have a trend following model in one of our products. It looks at a lot of different factors, like I said, but the most important thing is to track order flow and to know who your buyers and sellers are, and what drives them to buy and to sell, and how big their flows will be, at different moments. So we're always very carefully tracking kind of the bigger flows in the derivative space in particular, as well as the vol contingent strategies, and understanding at what points in the market they're likely to turn, and that's a moving function of time and vol, and also if they don't, when they'll turn and kind of be willing to stick their neck out and buy back as well. So. That's probably how we look at the world, and it's been very accurate, increasingly accurate with the increase in participants in the vol space as well.
All right, so a little bit of a heads up here, different tone from last time. Thanks for the walkthrough again. Cem Karsan is a senior managing partner at Aegea Capital Management. I'm liking these hits, even though I got to go watch them twice to make sure I understand it. Appreciate it, Cem. We'll chat soon.
Thanks for having me, OJ. Take care.